Let's talk about portfolio diversification and why it matters. Diversification is a risk management concept that allocates an investor's portfolio across a number of different asset classes and market segments. Typically, the more variety a portfolio has in investments, the less volatility it will incur over time. When I say risk, I'm primarily referring to equity exposure, or equity exposure to stocks like equity ETFs, equity mutual funds, and individual stocks. Being highly invested or concentrated in one segment of the financial markets exposes investors to a greater degree of what is called sequence of return risk. This is risk from the order in which investments returns occur. This risk can be meaningful, especially for retired or newly retired individuals because they are actively taking distributions from their portfolio. And if you have a highly concentrated equity portfolio when you are retiring and a recession or market downturn happens, you may be forced to take distributions on investments that are temporarily depressed in value. In this scenario going forward, it can drastically change the outcome of a retirement plan. Many people can be overwhelmed or intimidated by the possible swings in the market, while some relish it. For those who are at or nearing retirement, or are simply more risk averse, our goal is to reduce the stress of investing by allocating capital to asset classes that can act as a ballast for portfolios during difficult times, namely fixed income, also known as bonds and cash or cash equivalents, like money market accounts or high yield savings. For those who have a longer timeline or are more risk tolerant, we structure portfolios with higher equity allocations and other options. The key to diversification is investing in different segments of the market that tend to be less correlated to each other. This helps lessen the drawdowns on a portfolio, as our approach invests in areas of the financial markets other than just equities, like fixed income and alternative investments. This gives the portfolio a buffer to lessen the impact of negative equity markets. In a truly diversified portfolio, something will always be negative or trailing other positions. For the past several years, investors have gotten accustomed to unusually high returns, especially with US large cap stocks. While this has been to the benefit of many investors, there's a danger in assuming that past performance is indicative of future results. It is not. High concentrations, especially in market segments that have experienced outperformance, brings potential for added risk when, not if, markets turn negative, recess, correct, or even depress. One more note on diversification. Because of the strong equity market of the past several years, many investors have developed a bias toward US equities, especially large cap growth stocks. Based on valuations, we believe that investors may be overpaying for some of these companies. Much could be said about how this has played out and the possibility for the future. But the overriding point is that investors need truly diversified portfolios, not just what has worked for them in the past. At Smith & Howard Wealth Management, we take this into account and work with our clients to smooth the ride with a diversified portfolio that should help them achieve their plan without the risk of getting derailed every time the market goes through a difficult period. As I mentioned in my opening video, the path to financial goals starts with a strong financial plan, and the investment decisions that come from that are critical to your ability to meet your goals. At Smith & Howard Wealth Management, we prioritize planning on the front end, which allows our clients to set their goals and understand their risk tolerance level as our investment team develops their portfolio. If you have any questions about our planning or investment management process, please contact me. My contact information is at the close of this message. Thanks for watching.